Every investor asks the same question: how much could I lose? In finance, that question is answered by value at risk, or VAR. VAR gives you a clear, numerical estimate of the maximum loss you might face within a certain confidence level and time period. Think of it as the seatbelt of finance. You hope you'll never need it, but it's essential when markets hit turbulence. Whether you're an FRM candidate, a trader, or a risk manager, understanding VAR is a must. I'm the option guy, and in this video we'll break down what VAR really means, how to calculate it, and how professionals use it every day to control risk. Value at risk answers a simple but critical question: what is the worst expected loss, over a specific time, with a certain confidence level? For example, if a portfolio has a one-day 95% VAR of $1 million, it means there's only a 5% chance the loss will exceed $1 million in a single day. That remaining 5% represents the tail, the unlikely but possible extreme losses. So VAR doesn't eliminate uncertainty, it quantifies it. It gives risk a shape, a probability, and most importantly, a number that management can act upon. VAR is built from three key components. Small blue diamond confidence level: how sure you want to be, usually 95% or 99%. Small blue diamond time horizon: how long you hold the position, 1 day, 10 days, or more. Small blue diamond loss amount: the value at risk itself. For example, a bank might report, "We are 99% confident we will not lose more than $3 million in one trading day." This statement defines both their risk tolerance and their capital cushion. Higher confidence larger VAR safer portfolio. Lower confidence smaller VAR higher exposure. The logic behind VAR comes directly from the normal distribution, the same bell curve we discussed earlier. If returns follow a normal pattern, we can estimate VAR using \text VAR equals mu, z underscore alpha times sigma. Where mu is the average return, sigma is volatility, and z alpha is the confidence factor. At 95% confidence, z equals 1.65. At 99%, z equals 2.33. So if your portfolio has a volatility of 2%, an average return near zero, the 95% daily VAR is equal to 1.65 by 2% equals 3.3%. That means 95% of the time, you expect losses smaller than 3.3%, but 5% of the time, it could be worse. Imagine a trading desk managing $100 million in assets with daily volatility of 1%. At 99% confidence, z equals 2.33. VAR is equal to 2.33 by 1% times $100 million equals $2.33 million. So, 99 days out of 100, losses shouldn't exceed $2.33 million. But on that one day out of 100, the loss could be larger, and that's what risk managers monitor. This figure determines capital buffers, stop-loss levels, and Basel regulatory requirements in global banks. Mathematically, VAR expresses how far into the tail you are willing to look. The formula mu, z sigma simply subtracts a number of standard deviations from the mean. For a normally distributed return, this tells you the threshold where losses beyond that point are unlikely, but possible. It's like drawing a red line on the bell curve and saying, "We are this confident losses won't cross here." The z-score connects confidence to probability. A z of 1.65 corresponds to 95% confidence, meaning there's a 5% chance losses exceed VAR. A z of 2.33 corresponds to 99%, only 1% chance beyond that. The higher the z, the further into the tail you go, and the more conservative your risk limit becomes. In practice, traders balance precision with practicality: 95% VAR for daily trading, 99% for capital stress tests. Think of VAR as a 3D cube made of 3 dimensions. Keycap 1 confidence level, Keycap 2 time horizon, and Keycap 3 exposure size. Changing any one side of the cube changes the total risk volume. Longer horizon higher potential loss. Higher confidence, larger margin. Bigger exposure, higher VAR. That's why VAR isn't one fixed number, it scales dynamically with your portfolio and your assumptions. The historical simulation method looks backward. It takes actual daily returns from the past, say, 250 trading days, and simply sorts them from worst to best. The 5th percentile, or first for 99%, becomes your VAR. Example, if the 13th worst day in your one-year dataset was a minus 2.8% loss, then your 95% one-day VAR equals minus 2.8%. Simple, data-driven, and no assumption of normality, perfect for portfolios with nonlinear behavior or fat tails. The variance-covariance approach assumes returns are normally distributed. Using the mean and standard deviation of portfolio returns, you estimate VAR with the z-score formula. For example, if sigma equals 1.5% and z equals 1.65 for 95% confidence, VAR equals minus 2.48%. This method is elegant and fast, ideal for portfolios where risk is linearly related to underlying assets, such as bond portfolios or index funds. When portfolios are complex, especially with options or nonlinear instruments, we turn to Monte Carlo simulation. This method generates thousands of possible future outcomes by random sampling, based on volatility and correlations. From those simulated returns, you find the 5th or 1st percentile to determine VAR. It's computationally heavy, but powerful, and widely used by investment banks for pricing and risk assessment. Think of it as stress testing your portfolio across thousands of alternate market realities. On professional trading desks, risk dashboards show real-time VAR numbers alongside P&L, volatility, and exposure. When markets move sharply, these dashboards light up, warning traders as they approach or exceed their VAR limits. For example, during March 2020, COVID market swings caused daily VAR figures to spike dramatically, forcing firms to rebalance and reduce leverage. VAR isn't just theoretical, it's part of daily decision-making in every serious financial institution. Here's the crucial part most beginners miss. VAR tells you the threshold, but not what happens beyond it. That's where tail risk or expected shortfall comes in. Suppose your 99% VAR is $2 million, but on that one bad day, you might actually lose $4 or $5 million. VAR doesn't measure that, it just tells you where the trouble starts. That's why regulators now prefer expected shortfall, CBR. It averages losses beyond VAR to show the true magnitude of extreme risk. VAR has limitations. It assumes stable markets, fixed correlations, and predictable volatility, conditions that rarely hold during crises. The 2008 financial crash was a reminder, models built on normal distributions often fail under abnormal conditions. As professionals, we must treat VAR as a guide, not a guarantee. That's why risk teams also use stress tests, scenario analysis, and liquidity adjustments alongside VAR to get a complete picture. To summarize, value at risk converts uncertainty into a single, actionable number. It tells us how much we can expect to lose, within a given probability, under normal conditions. Whether you're analyzing a portfolio, trading derivatives, or studying for FRM or CFA, VAR gives you a framework to measure exposure and confidence. But never forget, models can guide you, not protect you. This is the Option Guy, helping you turn financial theory into practical understanding. Subscribe for more deep dive lessons on options, risk, and quantitative finance.